You know that feeling? You create this perfect, beautiful budget, and then reality just laughs at it? Well, that gap between your plan and what actually happens is a massive headache for businesses. And it has a name: overhead variance. Today, we're going to put on our detective hats and figure out exactly what's causing this gap, and more importantly, what we can actually do about it.
I mean, that's the big question, isn't it? You lay out a plan, you budget your costs down to the penny, but when the dust settles, the real numbers almost never line up. This gap, this variance, is what we're digging into. And our goal isn't just to find a number, it's to uncover the story behind that number.
So to get that story, this is our roadmap. You see, the total overhead variance isn't just one big problem. Think of it more like a family. It's the sum of 4 smaller, much more specific issues. We've got 2 that deal with variable overhead and 2 for fixed overhead. So for the next few minutes, we're going to break down each one of these piece by piece.
Okay, let's start on the left side of our map, variable overhead. These are all the costs that move up and down with your production levels, things like indirect materials or the power to run your machines. This whole branch really splits into 2 fundamental questions: how much did we pay for things, and how well did we use them? First up, we've got the spending variance. And listen, this one is purely a price issue. It doesn't care how efficient you were, it asks one simple question. For every hour of work we put in, did we pay more or less for our variable overhead items than we originally budgeted? That's it.
So how do we actually calculate this? Well, the trick here is to focus only on the price. The formula you're looking at does something really clever. It uses the actual hours worked on both sides of the equation. By keeping the hours the same, the only thing left to measure is the difference between the price we actually paid per hour and the price we thought we were going to pay. It's a perfect way to isolate the price problem. Let's make this real with our example company, Chowdown Inc. So they actually used 21,450 machine hours. Now, they budgeted to pay $8 an hour for variable overhead, but in reality it cost them $10. That $2 difference, multiplied across all those thousands of hours, ouch. That resulted in a $42,900 unfavorable variance. That is a huge overspend, and it's all because of price.
Now let's look at the other side of the coin, efficiency. This variance totally ignores the price we paid. Instead, it's asking, for the number of gadgets we actually made, did we use our time and resources as efficiently as we planned? In other words, did it take us more or less time than our own standard says it should have?
And the formula here is just as clever as the last one. We look at the difference between the hours we actually used and the hours we should have used. But, and this is key, to make sure we're only looking at efficiency, we multiply that time difference by the original budgeted price per hour. This completely strips out the actual price, so we're not blaming the production team for a price hike they had no control over. We're purely measuring their use of time.
All right, back to Chowdown Inc. Based on how much they actually produced, their standards said they should have used 19,800 machine hours. But, well, they actually took 21,450 hours. That's an extra 1,650 hours of machine time they didn't plan for. At that budgeted rate of $8 an hour, that inefficiency cost them an extra $13,200, another unfavorable variance.
So here's the really crucial takeaway. The total variable overhead variance is made up of these 2 completely separate stories. The spending variance tells you about your prices. The efficiency variance tells you about your productivity. By splitting them up, a manager knows exactly who to talk to. Do you go to the purchasing department about costs, or do you head to the production supervisor to talk about operations?
All right, let's hop over to the other side of our roadmap, fixed overhead. These are the costs that stay the same no matter what, like your factory rent. And just like before, this branch also splits into 2 new, distinct variances: budget and volume.
The fixed overhead spending variance is honestly the easiest one of the whole bunch. It's just a straight-up comparison. We budgeted a certain amount for all our fixed costs, rent, salaries, you name it. Did we spend more or did we spend less? That's it. It really is that simple. And for Chowdown Inc., this is finally some good news. They budgeted $450,000 for their fixed costs, but they only ended up spending $429,000. That created a $21,000 times favorable variance. So they did a great job controlling their fixed spending and came in under budget. Nicely done. Now for what is probably the trickiest one of the 4, the production volume variance. Okay, this one isn't about spending too much money or being inefficient. It's about using your factory space. Think of it like this. You pay rent on a huge factory because you're planning to make 10,000 units.
But what if you only end up making $8,000? You didn't overspend on your rent check, but you definitely had a lot of expensive, empty space just sitting there. This variance measures the cost of that unused capacity.
This visual kind of lays it all out. On the left, you have that simple spending comparison we just talked about. But on the right, you see the volume issue. We had a certain amount of fixed cost budgeted, but because we produced less than we planned, we didn't absorb all of that cost into our products. That leftover, unabsorbed cost is what becomes our unfavorable volume variance.
Now, this is a really, really important distinction. Why isn't there a fixed overhead efficiency variance? Well, think about it. Being inefficient doesn't make your fixed costs go up. If your team takes an extra 10 hours to build something, your factory rent doesn't change one bit. Your property taxes don't go up. Fixed costs are, well, they're fixed. So the concept of efficiency just doesn't apply to them in the same way.
Okay, so we've broken down all 4 of these variances. Now let's see how we can put them back together. Because, depending on who's looking at the report, whether it's a manager on the floor or a VP in the corner office, you might want to combine them for different levels of detail.
First up is what we call the 4-way analysis. This is maximum detail. You see all 4 variances laid out separately. This is the view for an operations manager, someone who needs to see the root cause of every single little thing that's going on. Next, we can simplify things a bit into a 3-way analysis. What we do here is combine both of the spending variances, the variable one and the fixed one, into one big total spending variance. This helps a manager see all the price-related issues in one single bucket, completely separate from efficiency and volume.
And finally, we have the 2-way analysis. This is the 30,000-foot view, the executive summary. It combines everything except the volume variance into one single number called the flexible budget variance, or sometimes the controllable variance. This is powerful because it separates the things that managers can generally control, like spending and efficiency, from the volume variance, which is often driven by huge factors outside their direct control, like overall market demand.
So, look, we've gone through a lot of calculations, but what is the actual point of all this? The single most important thing to remember is that these numbers are not just for accountants to file away. They are tools. They are designed to help managers ask the right questions and ultimately make better decisions. At the end of the day, this is what it all boils down to. Each of those 4 variances we started with is built to answer a specific, actionable business question. An unfavorable spending variance, that points you to purchasing. An unfavorable efficiency variance, that points you to the production floor. This is how you turn boring accounting data into real management action. And that brings us to one last crucial thought to leave you with. If you're a manager trying to guide your team, which of these variances is actually the least useful for changing their behavior? Think back through what we just discussed. Which variance is driven less by your team's direct, day-to-day actions and more by those big picture factors, like overall sales demand? Understanding that difference is the real key to moving beyond just the numbers and truly managing your business. Thanks for joining this Explain.